Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Welcome to another episode of the Mineral Rights Podcast. I'm your host, Matt Sands, and I have with me, as always, Justin Williams. Hi, Justin.
Good morning, Matt, and thank you for having me.
Thanks again for being on the show. And again, for those of you that are tuning in for the first time, Justin is a fellow mineral owner. And so we're going to talk a little bit about today working interest for mineral owners and, what does it mean and what are the pros and cons. So stay tuned and we'll get through all of that and give you a crash course on this so should you receive an AFE in the mail, and we'll talk about what an AFE is, you'll know what to do. So, Justin, have you run into this at all in your experience as a mineral owner?
Absolutely. This is something that, it adds a whole other level of confusion when you're getting into things. And I know for me, it was absolutely overwhelming to kind of understand what it is actually that I was going to be agreeing to, what my options were as a mineral right owner, executive rights as part of this. And I think it's something that it's a big question marks for mineral right owners can come up.
Yeah, I see this question a lot, in Mineral Rights Forum, and I get emails and so forth. And big question, kind of first, let's start out with kind of terminology. So we'll do some defining some terms you'll hear about or read about as it relates to working interests. So first of all, what is a working interest? So it is an ownership in the lease. Unlike the mineral estate, this is actually the leasehold interest. And what it would entail is participation based on a certain percentage that you would incur that percentage of the cost in drilling and completing and operating a well or wells. And also, you'd benefit from any revenue from those wells and or losses. So that's a thing that is a bit different. It's, from an accounting standpoint, you often hear of a passive investment versus an active investment. And while we're not here to give you tax advice and, go ahead and get a hold of your accountant if you have questions about this, but this is a situation where you would be actively investing in that oil and gas well. So that's kind of in a nutshell what a working interest is.
Absolutely. And I think a great note here too is it's something that it is a more of a risky investment than, let's say, royalties. It's something that, in the future you could be stuck with some costs for something that may have happened to the well. But oil and gas companies aren't in business to lose money. So most oil and gas companies do their best to run profitable with wells.
Exactly, yeah. So that's the bit of a leap of faith, I guess you would take in participating in a well. Usually what happens is they'll send you an AFE in the mail and there'll be a form, especially if you're an unleased mineral owner. They'll send you, some different options. And often what that'll include is, you can lease to us and here's our lease offer. You can elect to participate in the well, and they'll attach the AFE. Here's what we have as the anticipated cost. So this is not like a fixed price thing where they're just going to charge you that much. They're going to charge you however much it actually ends up costing to drill and complete the well. So they have a good faith estimate they'll put together, and that's what will be sent in what's called an AFE or an authority for expenditure, which is like a cost estimate. And you have the option then of saying, okay, now do I want to participate in the well and earn a percentage of that well for a percentage of that cost. So that percentage is, and sometimes it may vary, you may end up having a little bit depending on the wording, and this is where the fine print and getting a lawyer involved is always a good idea, like we always talk about. But let's just say for the sake of discussion here, you would pay 1% of the cost of drilling and completing a well in exchange for 1% ownership in that well, and as such, a 1% of the revenue generated by that well. So that's kind of where sometimes mineral owners will come across this is from an operator that is going to be drilling a well that their minerals would be a part of, and they are given a couple of options as to whether or not they want to participate in the well.
And again, just to kind of highlight what you said, I think it's super important. The devil's in the details when it comes to these agreements. And it's something that you really want to look at closely to be sure that you're receiving a good deal, because this is a contract with the oil and gas company.
Yeah, exactly. And while that, like I said, it's a good faith estimate, reality, once you get into drilling the well, they could actually end up having operational issues while they're drilling the well that would require them to sidetrack the well. In other words, they might get the bit stuck in the hole or a tool stuck in the hole and they can't get it out, and they have to go and drill down and then deviate from that original well bore to complete, the original path as closely as possible as they had initially intended. And what that means to you is additional time and additional cost before that well comes online. So while they may send you an AFE for $5 million, let's say, they could come in after the work is all said and done with a cost of $6 million. So there's a level of risk that you're taking on as it relates to the cost for doing the work.
And, I think it's not for every mineral owner. I think that there are certain situations and certain places that someone needs to be in to be able to really participate and feel secure in doing working interests. And I think a lot of people don't realize some of the downsides are, for instance, needing cash to contribute initially over the life of the well. That's going to be something that you have to plan for and can be a little surprising for mineral owners if they don't realize that.
Yeah, that initial, you may think you're done after that initial cash contribution, but really you're on the hook over that entire life of the well for whatever cost are incurred. Now, hopefully, to Justin's point earlier, that well is profitable, and the revenue that is generated from the oil and gas production would cover your cost. And a lot of times that's the case at the beginning of the well, when they have you have the benefit of good production coming off of that. You're close to when the work was done, so you have you could figure out what the oil and gas prices would be to go into your budget and how much you expect that well to generate as far as profit is concerned. But things can change. So some of the other potential downsides, in addition to that cash that Justin mentioned, is you really need to be aware of the fact that over the life of that well, you're going to have operations and maintenance costs. So they're going to send you some additional things. So instead of just getting a check stub each month that outlines the revenue generated, you're going to get a JIB or a joint interest billing statement that would outline your, the overall cost and then your percentage of those costs. And so that's a bill that you have to pay. So there's that financial liability that you then would be incurring as when you sign up to participate in the well. There could be other liability that goes along with that, and you may need to buy some insurance to cover that. So for drilling, and if there's any health, safety, or environmental issues, you could be on the hook. Your name's on that well as a working interest owner. So if you look at like the Macondo, kind of going back to worst case scenario, there, not that there would be an individual mineral owner there because it was a federal lease, but there were other operators that were minority working interest owners, and all of them got sued when that Macondo incident happened. So something you need to be aware of. And, along with that, we'd need to get with attorney and an accountant to figure out what's the best way to structure that, what kind of insurance you would need. So, what kind of entity you might want to hold that in an LLC versus holding it in just your name. Again, things that you would have to consider and talk with an expert. So, and all that it costs money, right? Talking to an accountant or attorney, they're not free. So that's, through the life of the well. And then at the end of the well, when the production is not profitable anymore, the company will plug and abandon or P&A the well. And you're on the hook for the cost of P&A in the well at the very end of the life of the well. So some of these things that you got to consider as potential downside, and you got to be willing to lose that entire investment. So it's definitely not for the faint of heart and not for somebody that's maybe living paycheck to paycheck. So this is, to do it justice, you would need to be in a good financial situation and have plenty of disposable income, that this is something that you're doing for tax purposes or for investment purposes as a savvy investor. And so these are the types of downsides you need to think about. There are also upsides to it too, Justin, that, you got to consider.
Absolutely. And I think that's a decision that mineral right owners have to make, and they really need to be informed when they make a decision, because at times it may make sense to stay an unleased co-tenant or to be in a joint venture with the oil company But how do you determine that? I mean, that's the hard thing for a mineral right owner. I'm actually in a situation now where I have just that on the table. I've got to determine whether it's my benefit to sign a lease and take the bonus in return for a reduced royalty rate, or whether I should stay an unleased co-tenant in the area and take some of the risk of the production cost in return for a larger percentage of the revenue.
And that's sometimes a difficult thing to determine on your own. Definitely this is a situation I think where you'd want to get some help with evaluating that. If you are in the position, like we mentioned, all those things don't sound scary to you, then that's where you would hire your advisors to help you navigate particular proposal to see if it makes sense for you to participate. The upsides, you do have some tax benefits from that. Again, you'd have to get with your CPA to really discuss your particular situation, but that is a potential upside. Could be a good source of revenue. So you have a 1% interest in a well. And if it's a really good producer, that could be a significant amount of money. That would outweigh the potential cost, operating cost in a good sort of scenario. So something you would have to consider. Again, it's probably more than we can cover in a short episode here today, but again, it's similar to valuing minerals in that you're looking at what the potential revenue would be from a well that's drilled. So you would need to have an understanding of what the typical wells are in that area, analog wells, and be able to forecast production for any undeveloped wells. And then you'd have to subtract what the expected operating and maintenance costs would be based on that operator's history in the area. So this is a situation that, having knowledge of operators and what their, sort of cost structure and history is in that area becomes important. And weighing all that together, you do say kind of the same thing, that income analysis we talked about in the previous episode. If you haven't listened to that, go ahead and listen to that episode. We talk about how minerals are valued, and there's a couple different ways. And one of them is by looking at sort of the sum of discounted cash flow over time. And that same methodology would be used with this non-operated working interest, but then in this case, you'd be subtracting out whatever your percentage of the cost would be over the life of that well. And then you put in, what the potential cost to plug and abandon the well is at the end of the life. And that's where you can come up with a value and say, is this a positive number? This net present value, is it positive at my designated discount rate? And if it's positive and it's a good deal and you're willing to take those risks, and that's how you would sort of assess how that's done. But it's a pretty in-depth analysis that you would need to be done by an expert.
And I think a couple great points to mention on this topic too is a lot of people who really get into this world and play in this world form an LLC to help protect themselves and put a layer between them and actually working with these oil interests. And there are things that you can do, and talking with an expert is a great place to start before you commit to any of this. But another thing I think that'd be great for you to speak on, Matt, is if I'm a mineral right owner and I have working interest and my top priority is to divest that working interest and get rid of the liability, what are my options as a mineral right owner?
If it's a profitable working interest, that may not be that difficult to divest it. I've seen on auction websites like EnergyNet, pretty frequently there'll be non-operated working interests that come across there. So that would be an option. So going through a broker or an auction website like EnergyNet to try to divest it if you find that maybe it's more than you're wanting to take on down the road. Or if your financial situation changes. The scenario is different if it is not a profitable working interest. So if it's losing money every month, you're going to have potentially a hard time selling that. You could talk to the operator; they're likely not going to want to buy it from you. That's another person you could talk to is the operator to see if they'd be willing to buy it from you, but. Yeah, it's a difficult thing. If it's losing money, you may be stuck with it, and so that's where you need to be willing to foot the bill over time and not have that money be impactful to your overall bottom line. So that's something to consider as well.
Absolutely, and I think there's something to mention as well is that this is a piece of a portfolio when you're an investor. This would be on the high risk side of a portfolio, and you would be sure you want to have some balance. Also, another thing to consider is with plugging and abandoning, the typical lifespan of a well can be anywhere from 25 to 35 years and beyond. So you need to be mindful that you may actually stick your heirs with the liability to pay the plugging costs. And you kind of need to be on top of that with your estate planning if that's something that you want to be careful of.
Yeah, that's a great point because, if it's just you and you're comfortable with it, that scenario may change drastically if you were to pass and this were to be handed down to your heirs, like Justin mentioned. What's their level of comfort with managing a non-operated working interest? And do you have other revenue from other investments that would cover potential costs so you're not burdening them with liability that they didn't expect? So it's something to think about. It's definitely got its thorns, but it can be also a very profitable venture. Like Justin mentioned, it's just, oil and gas companies are in the business to make money. Especially, this is where I think, too, you would really need to be careful as to which operator you're going into business with. So, if they've got a good track record, they're reliable, they've been around for a long time, they're going to be around to help with any environmental liability, and their operating costs are reasonable. That's another huge factor to consider. So all of those things go into this as kind of into the overall decision. So one term also I want to throw out there, just because you may hear this, and I'll throw in a scenario. So if you're in a non-operated working interest and you hear the term non-consent, I'll just talk a little bit about what that means. So let's say the well's already been drilled and it's producing, but then there's some sort of operational problem. And so the operator proposes to work over the well to restore production or to stimulate production. Maybe they want to recomplete the well, let's say. They're going to propose the work under the Joint Operating Agreement, or the JOA. So that's the document or the contract that governs the relationship between the operator and the non-operated partners. And so if you decided to elect to participate in that work, you would owe your portion of the cost for that work. If you decide to not consent to that work, then you would be going non-consent. That's a term that's used. And then you would be subject to a non-consent penalty, which would be some multiplier of whatever cost for doing the work before you're allowed to receive revenue again. So a lot of times it will happen on maybe a 200 to 300% multiplier on the cost. So they need to get that money back. In other words, they need to recoup those costs before you start to receive revenue again. And typically on the joint interest billing, that'll show that. So if you did go non-consent for some work, it'll show you, how much of that cost has been recouped and how much is left to go, so that you can keep track of it. But that's something that is often talked about, is going non-consent on a well, and that's what that means.
Absolutely. And, I think that's something, too, that it varies by state. And at times, talking to the operators can be very confusing with some of the terms that they throw out. And I think having a trusting resource is always a good person to go to and kind of ask them to really, truly understand what it is that they're telling you.
Yeah, that's always helpful to have that decoder ring, so to speak, and have somebody you can go to talk about that. And which is what we're trying to do today here a little bit for all of you listening. So hopefully this is helpful. Just again, a short episode today. We wanted to cover what is a working interest, what are the pros and cons. Another scenario that I'll talk about, and I just ask you a question. Have you ever gotten a call, Justin, from sort of someone out of the blue just asking you to invest in a well or anything like that?
Yes, absolutely. And I have actually myself gone seeking investments like this and watched many, many YouTube videos, read many websites, and they sound wonderful. But there is a downside and a flip side that is not so wonderful.
Yeah, and this is these unsolicited calls. This is something where you got to be really careful, because it's usually a really small operator, not a lot of history. So there's another level of risk associated with it. And if the investment opportunity sounds too good to be true over the phone, then it probably is. And a lot of times, Justin mentioned, the devil is in the details when it comes to the contract. And some of these less reputable operators will try to stick you with a higher percentage of the cost than the percentage of the working interest that you would earn. So not saying that all those folks are are bad, but you got to be really careful with that. And I would, just as a rule of thumb, I generally shy away from any of those unsolicited offers like that, because there's a reason why someone else didn't elect to participate in that investment, and why they're still trying to find people to help them in sort of with the cost of drilling a well. So there's something to be aware of. If you do get those kind of unsolicited calls, usually my rule of thumb is to run as fast as you can away from that opportunity. But
absolutely, and I think a great red flag is oil and gas is a world of real property. You get a deed, you receive a piece of property in some way or another. And a lot of these investments that I have seen, that's not at all the case that you're talking about when you're talking about an investment. You're simply just signing a contract with this company that says you're going to participate and pay cost, but you're really not receiving any real property in return. And that's a huge red flag.
Yeah, that's a risk, definitely. Any other parting thoughts before we wrap up today?
I think a great thing to mention when it comes to any kind of working interest or mineral rights, I had a situation where I had somebody come running into my life very quickly looking for me to sign a lease. And I think that's something for mineral right owners that should throw a huge red flag. This person in particular, you've got to ask some questions. Are they looking to flip the lease? Are you losing something by signing this lease? Is there somebody else that it may be more beneficial to bring into the picture and have them compete on a lease? But it's definitely something worth doing your homework. And just because somebody's knocking at your door doesn't mean that you necessarily need to sign right then.
Yeah, that's a good point. And especially if they're pressuring you, time pressures, or asking you to do some things that are sort of interesting around backdating the lease to a certain date. I know that I've seen that as well. Some of the things that you need to consider, especially in your case, was this something you inherited from somebody and sort of surprise, you get a call out of the blue, hey, we'd like to lease your interest.
Correct.
A little bit about what it is.
Absolutely. So we had somebody come in that was looking to lease our interest and told us that we were one of the only unleased interests in the area. Come to find out there is actually a producing well on the property. So it raises even more questions of if this person is just trying to squeeze their way into making some profit from the well. Should we go to the operator who's running the well and sign a lease? Should we sign a lease at all? Should we remain unleased co-tenants? But this person came in very quickly, wanted a backdated lease, got me an offer very quick, and it just seems too good to be true, which is a big red flag. And this is something that, I think it's going to be a case of doing our homework, and most likely they are bringing up some questions that it's not going to be in our best interest to sign a lease with the person that flew in.
Sounds like you're like you said, you're probably in a better scenario would be to try to get some competition for that if you do decide that you want to lease. And like that first offer, like we always talk about, is probably not the best. So, you
consider in this as well that I think is always really important is when you're evaluating the operators that you're going to sign a lease with, if you're going to be bearing cost in any way, which with a lease you usually don't, but if you're an unleased co-tenant, you might, do you trust that operator to truly account for the cost correctly? Because I know that's something that happens a lot to mineral right owners, and there's some games that can be played. But Matt, you would know this better than I, but I think there's limited ability for the mineral right owner to ask questions to the oil company and to receive accounting statements. Sure, they'll tell you how much it costs, but does the mineral right owner really have the right to question how much they spent on gas?
Yeah, as a mineral owner, say you're a leased mineral owner, that's a scenario I think where you really wouldn't have the right. You could always ask. They could always tell you. They're probably going to tell you no. If you are a working interest owner on the other side, though, you actually have the right to, and again, it depends on let me say this, step back a second. It depends on the joint operating agreement, but in general, you would have the right to question the costs that they're billing you for and potentially ask for some backup documentation. So that is something that you would have with a working interest versus just as a mineral owner. The cost of their cost of operating and maintaining the well typically is off the table for you to get that information. You would be able to ask about any deductions. So you'll see deducts on your check stub. It may have things like transportation costs, dehydrating, processing, etc. And you can always ask about so what what are these costs, and particularly if you have a lease that has a limit on the amount of deductions they can take. Sometimes, to your point, Justin, they may make a mistake or may charge you more than what you're really liable for, so to speak, in terms of what you've agreed to in that lease as far as those deductions are concerned. So in that case, it's always a good idea to do a mineral audit, so looking at your royalties that you're getting, and particularly if you see those costs creeping up, it's something that you'd want to dig a little bit deeper to understand why. Dust off your lease and take a look at the section that talks about the royalty rate and the deductions, and make sure that they're actually following that, and that there's not some mistake in their system that they're charging you for more than they should. So definitely something to kind of a best practice to do on a periodic basis.
And, again, the devil's in the details, and I think each state has different statutes that interprets the way that they understand leases specifically on what costs can be charged. So it's not always super cut and dry, and maybe it's something that you really need to speak with an attorney about.
And this is probably something that we will need to cover in another episode. I think that's a really good topic, is just to break that down in more detail and help people understand what are some of those typical costs, and then how to do that kind of an audit for yourself. And again, if it becomes too burdensome, or if you have a lot of royalties coming in, it could be more than you're able to actually bite off on your own. And so you could get an accountant or a minerals manager to come in and help you with that.
Well, and I think that's a great overview, Matt, of working interest for our mineral right owners. And it's something that you really need to ask lots of questions, and we invite people to leave some comments in the blog post that will be for this, or a link under this in the podcast. And we're glad to answer any questions that we receive.
Yeah, thanks. And you can find the show notes at mineralrightspodcast.com. And if this has been useful information, please subscribe to the podcast on iTunes and leave a honest rating and review. We read every one, and we greatly appreciate it. And every review we get will help this show get out to more people. So thanks again for listening, and we'll talk to you next time.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.